Welcome to all of you, and most hearty welcome for the first webinar of the Sino-German-Center this year. All our best wishes for the participants, the speakers, the auditors. I think this year we will be as fast as rabbits, and we have an interesting program today. Our main speaker is Dr. Klaus Bauknecht, the chief economist from IKB, Deutsche Industriebank. But the first remarks will come from my colleagues, Professor Horst Löchel from the Sino-German-Center, and then he will be followed by Klaus Bauknecht. He has a PhD from the University of Stellenbosch in remarkable philosophy, as I learned. He worked between 1998 and 2003 in Johannesburg and Pretoria, different positions in commercial banks and the National Treasury of South Africa. Since April 2004, he is head of econometric and capital markets research at IKB and has a marvelous record on publications, wage price spiral danger, and specifically in November on our today's topic, how dependent is German business from China? And we will see how will this work out and how we can comment this. But first, Horst Löchel, your remarks on the macroeconomic side.
Yeah, thank you very much. Also from my side, a warm welcome in the new year. I mean, for the Chinese, another new year starting over this weekend, as you know, the year of the rabbit. Also, thank you very much for Dr. Bauknecht to be here as a keynote speaker. I want to give in the beginning a short remarks because we did some research here at our Sino-German-Center, and I want to present, let's say, the main results more or less in a nutshell. First of all, I think this debate on economic dependency was very much pushed by two important events in recent time. One, of course, is the COVID-19 pandemic, and the second one is the Russian invasion of the Ukraine. And both events contributed very much to the already ongoing crisis of globalization and deepened somehow the ongoing and existing fragmentation of the world and the world economy. But the topic is also very much important in political context, as you know. Our government is underway to design a so-called new China strategy, and we got the public get to know some guidelines already from two of our ministry, the Ministry of Foreign Affairs and the Federal Ministry of Economic Affairs and Climate Action. They focus on a lot of points, these two papers, but most important, or one important point, is the so-called perceived dependency of German business in China and strong advice for more independency and diversification. I like to give three comments on this overall debate. The first comment is that, of course, the economic relationship between Germany and China cannot be compared with Germany's completely one-sided dependency on Russian gas in the past. The business between Germany and China is much more diversified in general. It not only covers raw material from China, but also mutual exports and imports in production inputs, in consumer goods, but also a mutual foreign direct investments of German companies in China and the other way around. And so far, in the last 30 to 40 years, this works very well in the benefits of both of our countries in terms of income and as well as in employment. China is relevant, but China is not a dominant trading partner for Germany, and so-called critical and strategic dependency are rare cases and should be not confused with cluster risk of German companies and their business in China. So the bottom line of this first point is that economic dependency of Germany on China is highly exaggerated in the public debate for whatever reason. The second one is that the second point I like to mention is that the degree of dependency, the quantified degree of dependency, depends very much on the methodology, how it is measured. Dependency as such is more or less a useless concept, given that any business implies dependency. A proper concept that emerged in the relevant literature, especially for imported goods and commodities, the so-called strategic dependency. And strategic dependency covers two criteria. The first one is you have to have an import share of more than 50% of a special good or raw material from a country. But this country has also to have a global share on this good of more than 30% of the export. Take, for example, what does it mean in practice? Take, for example, the very much discussed case of raw earth metals. Of course, it's right that the German industry has a share of 50% or more from China in the import of this raw material. But however, does it mean that Germany is strategically dependent on China in this regard? The answer depends a little bit, because you have to add the fact that the global share of China on this rare earth metal is less than 30%, or globally, internationally. For most of the cases in the last 10 years, that means that the substitution elasticity for the German industry is high, or in other words to say, there's a lot of other possibility to get raw material. We're not strategically dependent on China, or the German industry is not strategically dependent, but voluntarily. And if they want to change this, they can change this, because there's a lot of other countries providing this raw material. So the question of substitution, which is very often not mentioned, or substitution possibility, is often not mentioned in this debate, matters very much for the question whether we face economic dependency in special goods or not. Moreover, the time horizon matters. You read a lot of things in the newspaper. For example, last time, 30% in average of electronics used in German industry in the year 2020 have been from China. This is right. However, if you extend the time horizon, for example, 10 years or so, then the number or the share already decreased to around 1% in average. And in a 5-year framework, 2016 to 2020, to 2.3%. So the 30% figure is only a snapshot and cannot be really a proper justification for economic dependency. However, what we know if we go for a period of 5 years is that more and more imports from China are concentrating on production imports and less to consumer goods, which means that the produced value added in Germany relies to a higher degree on Chinese imports. Bottom line of this point is the degree of substitution possibilities as well as the time horizon has to be considered by classifying dependency. And if you're doing so, there are not much imports from China left where we have really strategic dependency. My last point is that reduction of dependency by diversification cannot be an end in itself. For instance, by concentrating or even restrict German trade to so-called value partners and friendshoring, but have to be judged in terms of benefits and cost for the German economy. I don't think I have to mention that Germany, like China, is very much a trading nation. And our economy, the prosperity model of our economy, one cornerstone is, of course, a lot of exports, high-value exports, and a lot of relatively cheap imports. And any diversification, of course, have to pay attention to this special model and not jeopardize it. The bottom line of this point is the German business with China, depending or not, is economically rational because it increases our own welfare. Having said that, this is my point, and it's now my pleasure to hand over to Dr. Bauknecht for his keynote speech. Please.
Yeah, thank you very much.
I'm very pleased that you spent some time on explaining dependency and how it can be measured, because that's the point of my short presentation, in the sense that we have to distinguish between interdependency and dependency. Dependency has a negative connotation to it. I'm at the mercy of some other country. And this certainly does not apply to China. That's actually the main key takeaway of my presentation, as there is a high alignment of interest. Yeah, we had trade data coming out on Monday. And again, the word dependency on China was headline news. And the point was that because the import growth, German imports from China have grown a lot faster than German exports to China, we have become more dependent on China for our resources. But this is of course not surprising, given that the Chinese economy had a very weak growth last year, and the German economy didn't do so bad after all. I mean, this has nothing to do with some structural developments. This is just a cyclical development. But again, here you can see how this term dependency is being explained as something negative. I mean, trade implies some interdependency. That's not necessarily a bad thing. How else will we be able to specialize, especially the German economy, if it were not for increased trade and interdependency? Okay, I'm a bit surprised about this discussion on dependency in China. I mean, at the end of the day, and IKB is a German bank that lends money to the German corporate sector, to the mid-sized German corporate sectors, the so-called Mittelstand. And most of our clients have exposure to China. They either export to China, or they import from China, or they have production capacity there. And the question to them is simple. Do I want to have growth or not? Do I want to participate in the global growth dynamics, which primarily come from China? 2/3 of global growth is generated in Asia. And this whole debate of dependency really only came up after the COVID pandemic, where the value chains broke, and suddenly we're getting aware of a so-called dependency on other countries. But of course, the breaking of the supply chains had nothing to do with China. I mean, it wasn't China that deliberately broke the links to German production. On the contrary, most of our clients tell us that China has a keen interest in making sure that the German manufacturing sector does get its goods from China. And China, of course, if you look in a global perspective, 1/3 of global growth is from China. So the world economy is heavily dependent, you might argue, also on China. There's no other region or no other country that can compensate the growth contribution that China has made over the last couple of years. And dependency, if I may use that term, dependency isn't that bad. If we think back to the financial crisis, 2010, 11, 12, we were very glad to have a dependency on China because it helped us to recover fairly quickly from the financial crisis. Whereas the US had big problems, but it was China, through its fiscal stimulation, that allowed also Germany, through its exports, to recover fairly quickly. So dependency is not just this negative connotation that one mostly hears of, but there are some positive effects if you want to focus on dependency. But my point today is the issue of interdependency. I mean, we have this idea of China being here, this big villain that focuses only on its own interests, and in doing so will basically do whatever it takes and ignore the rest of the world, right? That's this kind of image that we very often have of China, and that's just far from the truth. In the sense that, especially since China joined the World Trade Organization, there's been an increased integration of the Chinese economy into the global economy. If you look at the trade flows, and the same applies for growth. I've put together some simple correlations here on the left-hand side, and we can see that the correlation Chinese growth to global growth has significantly increased since 2000. I mean, China doesn't grow by exporting and thereby actually taking growth away from other countries. It is growing on a fairly balanced note. As you can see from the bottom, the trade balance as a percent of GDP is fairly stable. It's not the situation that they are just exporting and thereby making a negative contribution to other countries' growth. And as a result of that, we have an increased alignment of growth between China and the rest of the world. And of course, Germany, which is heavily dependent, of course, given our openness, our degree of openness to the world economy. So we see a significant increase in co-movement of Chinese growth with global growth. Significant increase since the joining of China in the global community, I might want to say. There's a decline to the US, and again, that makes perfect sense. The time when China exported and grew through exports by producing cheap goods for the US, those times are over. China is becoming an integrated global player. And so the point here is that whatever is good for the global economy is also good for China. This idea of China on the one hand and the rest of the world on the other, that's an outdated concept. To achieve China's goals of a higher per capita income for its population, it needs the rest of the world. It needs the imports, it needs the export markets. It needs overall, the global community for it to succeed in its growth goals. And that is the result of this increased integration that we have seen with China. So we have interdependencies. We don't have dependency. China can't pursue its goals independently without harming its economy. And we've also seen this when we had the debate with Trump, with the trade agreements, how China at the end did concede to certain demands from the US, being full aware that we're actually all sitting in one boat. And of course, China is also becoming far too big for it to have an independent role to the rest of the world. If you look at Germany, and already we've heard that the German imports from China are changing, the basket is changing, and you can see this quite nicely here on the right-hand side, that as we've already heard, the intermediary goods play an increasingly important role, whereas the final consumer goods are becoming less important. You can see that the share of electrical equipment and machinery is increasing over the years, whereas the computers and the final consumer electronic goods, their share is declining. So yes, China is playing an increasingly important role in Germany's value chain. But that is important for Germany to reach its goal. We're a country with skilled labor shortage. We read it every day in the paper. We're a country with a potential output growth of under 1%, so we're told. So where's our growth really going to come from? It can only come from increased specialization and outsourcing of things that we can't do that good. And that means an increased integration of Germany's value chains in the global economy. That's a logical consequence of globalization and of Germany wanting to achieve its goals, namely of maintaining, in spite of scarcities in the production factor labor, of achieving somewhat a reasonable growth. I mean, we're actually much more dependent. If you look at the trade, and again, we heard that already. China is not the primary trading partner of Germany. It of course remains the Eurozone primarily. Not surprising, of course. But the arguments now that we hear, we need to have a deglobalization, whatever that means. I mean, first of all, there is no deglobalization. Trade does not decrease in absolute terms. It might not grow at the same pace. But then, of course, it can't grow indefinitely at twice the pace of global GDP. It just doesn't work, right? So there is no deglobalization. What we do see is that trade growth is moderating, but again, there is a very good reason for that, and that is that German companies, in particular, are globalizing not by exporting goods and importing goods. That's the one side of the aspect, one side of globalization. But they're globalizing primarily through capital, of course. German companies. I mean, how are we going to maintain our global market share in a world that's growing that has 3 times the potential growth that Germany has? Only by utilizing foreign production factors. And China is playing a key role in that. And if we look at and that's maybe the issue here, so we have an alignment of interest as far as trade is concerned. And the argument that China is going to pursue its own goals, it can only pursue that with the help of the rest of the world economy, given its increased degree of integration. But if you look at the capital flows, the FDIs, there the picture is a bit different. I mean, we see that the biggest export of capital, import of capital remains the US. And Germany is exporting most of its capital still to the US. No question about that. But we can see that German companies are investing an increased amount in China. I mean, there's a huge discrepancy between Chinese companies investing in Germany and German companies investing in China. So there's clearly, if you might want to call that way, a misalignment of interest. And China has become a net exporter of capital. Again, that is not surprising. It's not as if China wants to buy up everything that one often reads in the paper. It's a logic consequence of its stage of economic development. They're now becoming to the stage where they're increasingly becoming capital exporters, as we are in Germany, of course, as is the US. But we have this discrepancy that German companies invest a lot more in China than Chinese companies investing in Germany. And if we're concerned about dependencies, we should not only ensure that our trade flow is not balanced, but there is a both-way interest in our trade flow, but also that we have some increased capital investments of Chinese companies in Germany. This is seen as a huge fear that they're going to export patents and knowledge and so forth. And again, I guess one has to be a bit careful here. But if you look at this graph, this picture, bottom right, top right, you can see that there's a huge German companies. There is a tremendous amount of money, capital, assets that the real German manufacturing sector has invested in China. And to make sure that that's not going to become sunken cost, we need to make sure that our economic cooperation and integration with China continues. Otherwise, it's going to be a tremendously bad investment. And there's no reason to expect that, as I said already, with regard to the trade flow. Okay, so the key takeaways, just to sum it up, how are we doing on time? Oh, so I'll have a couple of minutes. The discussion of whether we have become too dependent on China misses the point. China is an integral part of the global economy and of global growth. And the argument that China pursues its own interest, every country does that. That's fine. The key point is to ensure that those interests are somewhat not completely orthogonal to the German interests. Trade specialization, higher productivity necessarily implies the greater dependency on partners. Again, being dependent on somebody else is not such necessarily a bad thing. The reshoring debate is not a solution. I mean, we need more robust value chains and diversification. And the experiences during COVID is, of course, no reference. Indeed, we're discussing our value, how fragile our value chains are. I look at global growth, I look at global industrial production, and I'm amazed how the global economy has recovered from this pandemic, this global pandemic, when in April 2000 we thought this is the end, right? This is the end of the world as we know it. I think that's a good song. And look how the global economy has recovered. So the argument that globalization didn't work and supply chains are so fragile, if you look at the big picture, no, it's been a tremendous success. Diversification is always beneficial. Every asset manager will tell you that. The focus should not be on reducing dependencies, but ensuring alignment of interest. And that of course, is an issue that one should address in the sense that we should actually encourage Chinese capital to settle in Germany, so that the Chinese value chain is also relying on German value-added products in its production process. Chinese interests are increasingly woven with the world economy. I already made that point. I've shown you the correlations and some of the empirical work that we have done there, and that's pretty much what I have to say for now.